Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Are you ready for some straight talk on retirement planning without all the fluff? Well, you found the right podcast. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to another episode of the Retirement Made Easy podcast. I'm Greg Gonzalez. Thanks for joining me today. This episode is number 189. We're going to talk about the big, beautiful bill that just passed in the House and the implications that it would have for pre-retirees and retirees. That'll be the first topic of discussion on today's episode. Then we're going to jump into listener questions. The first of which is an extensive topic that I'm going to have to do a deeper dive on our YouTube channel. And it has to do with withdrawal strategies. A lot of people have the question, okay, once I retire, I've got all these various accounts. I've got a 401k, I've got a Roth 401k, I've got a rollover IRA from an old job. We got brokerage accounts. We've got life insurance policies. We've got all these different accounts. But which account do we start drawing from first? And I get this question over and over, but that's going to be the first listener question. Then I've got 3 or 4 more, and we'll wrap up this episode going through those listener questions. So a lot to talk about. If you're a new listener, I invite you to check out our website, retirestrongfa.com, download our free resources, and check out all of the previous episodes. There's 188 previous episodes. And then as a reminder to everybody out there, we do have a YouTube channel called Retirement Made Easy. You can listen to all the previous episodes there, as well as some videos that we're releasing. Shorter videos. We're not going to do like hour-long videos or anything like that. But I'm working on some Social Security videos, some retirement withdrawal strategy videos, retirement plan videos, walking people through visually. That's, I think, the great benefit of YouTube is I'm able to use images, share my screen, and walk the viewers through different concepts. And hopefully there's a lot more takeaways with my ability over YouTube to share my screen, to share visuals. And for all those visual learners out there, they tend to gravitate towards YouTube. So check out YouTube, Retirement Made Easy. And the last thing I'll mention is, of course, you can subscribe to the YouTube channel, but we're not going to have advertisers on this podcast. We're not going to have advertisers on the YouTube channel because I want to keep the focus on educational, informational topics that can help you plan for a successful retirement. All right, let's switch gears. We want to talk about this big, beautiful bill. If you haven't heard the headlines, if you haven't seen Donald Trump's tweets, this new tax bill, it actually passed in the House by 1 vote. So it's on to the Senate. There's an expectation that there's going to be some modifications or changes before it will pass. So we'll just have to see what the final bill ends up being and what's really included in it. Now, here's something that I find interesting because I did a lot of research on this in preparation for this podcast episode. Depending on which article that you read on the internet, that will determine your attitude or your takeaway on this bill. Because a lot of these news outlets, as everybody knows, are so politically driven one way or the other that just the tone of the articles, you can tell what the journalist or the author, which way they lean, so to speak. What's really fascinating to me is I read through dozens and dozens of the bill itself is over 1,000 pages to give you any idea of the scope of this. But articles, that clearly these people don't know what they're talking about and didn't read the bill because there's conflicting information of what's actually in the bill itself. And I could give you countless examples, but let me just give you the facts and really how this bill, if it becomes a law, is going to impact our average listener out there. The 55 to 70-year-old pre-retiree, early retiree out there that's listening to this Retirement Made Easy podcast, how is this bill going to impact them? And if I'm giving you my opinion, I would tell you it's really not that great of an impact, not like it was supposed to be anyway. And here's what I mean by that. If you look at an article that was dated May 16th, 2025, it is called "One Big Beautiful Bill is a Once in a Generation Chance." And this is whitehouse.gov. This article is on whitehouse.gov, May 16th, 2025. We'll link this in the show notes. And it says the largest tax cut in American history includes no tax on tips and no tax on overtime. And it provides historic relief, tax relief to Social Security recipients. It slashes taxes on seniors' Social Security benefits. And I'm here to tell you, in the final bill that passed in the House, that section was not included whatsoever. So there's going to be no changes to taxes on Social Security income with the bill that passed in the House. But if you read this article that's still there on whitehouse.gov, May 16, 2025, it leads you to believe that, hey, federal income taxes on Social Security income is going away as a result of this bill. And again, that is just not the case. That did not get approved in that section of the bill. So what did get approved and is in this bill, and how's it going to impact the people that listen to this podcast 55 to 70? Well, really what it's going to do is extend the Tax Cuts and Jobs Act that was put into place in Trump's first term, which was 2017. And if you had listened to this podcast before, I had predicted that, yes, it would get extended. This happens quite often. Even when Obama was president, he actually extended the Bush tax cuts. So this is not a big surprise. So the tax code that we're under right now is not going to sunset, according to this bill, at the end of 2025, if this bill gets approved in the Senate. So we would remain under the same tax code with some subtle changes here and there. And what are these subtle changes, and how are they going to impact the person 55 to 70? As I review the bill, the biggest couple things that kind of stick out to me are the standard deduction is going up $1,000 an individual. So for a couple, that's $2,000, bringing the standard deduction to $32,000. And for seniors, which is 65 or older, the standard deduction, you get an additional $4,000. So that's nice for anybody 65 or older. They'll have a higher standard deduction. The bad news is this change to the standard deduction, it's only for the years 2025 to 2028. And the other thing is it is income-based, so it phases out $75,000 for people single, married taxpayers making above $150,000. What you'll find is, if you read in the fine print with a lot of these changes, is a lot of times it's income-based, and some of these changes will phase out in 2028. Many of them phase out in 2028. Another example of this is the no taxes on overtime and tips. This would just run from 2025 to 2028, and this was a change that had been talked about quite a bit. And here's another tax deduction that people are talking about. This is the no tax on auto loan interest. And so this is for vehicles purchased between 2025 and 2028. The interest is going to be tax deductible. There are income limitations to this. For example, married filing jointly looks like $200,000, and this deduction is limited to $10,000 overall. And the idea here behind this auto loan interest deduction is it only applies to vehicles that are completed or assembled in the United States. And I believe the effort there is to have more auto manufacturers produce more vehicles in the United States and also get more American consumers to buy vehicles that are manufactured in the United States, which is good for jobs. Here's something very small, but for those charitably inclined, there will be a charitable contribution made between 2025 and 2028. Even if you don't itemize, you can deduct $150 per taxpayer or $300 for couples. So for those people that don't itemize, that aren't able to deduct those charitable contributions, now they can up to $300 for a married couple. There's something else that might be applicable to our listeners' grandchildren, most likely. For children born between 2025 and 2028, there's what's called a Trump account. And basically, the U.S. federal government's going to give $1,000 credit into these accounts. And the idea here is it's putting money away for the future so that when the child turns 18 or later on in life, they have money to help pay for higher education, apprenticeships, starting a small business or maybe that first home purchase. Now the money grows tax deferred, and then when you take it out, it looks like they're going to be taxed at capital gains rates. The next two changes are probably the next biggest, and I'll wrap up there. But changes to health savings accounts. And I always had a big beef with this. So for someone that's working at 65, and let's say they have an HSA because they're covered under their group health insurance. If you were to sign up for Medicare Part A, you can no longer contribute to that HSA. And I never thought that was right. So there's a change in this bill that it would allow you, if you sign up for Medicare Part A, you're still working at 65, you can still contribute to that HSA, which I think that's really good. The other thing is it opens up the doors for HSAs. One of the things that it's going to do, a lot of changes to HSAs it's looking like, but one of the things is they're increasing the limit of how much you can per year. And so married taxpayers making under $150,000, right now the limit is $8,550 per year. And that is going to essentially double to $17,100. So that's for those that can contribute to an HSA. They know how valuable they are. And if that limit goes up to $17,100 per year for a married taxpayer for a family limit, that's huge. And for single taxpayers, it's at making under $75,000, your contribution limit would go from $4,300 a year to doubling to $8,600 a year. So that's another thing with a lot of these changes is a lot of it's income based. So you'll want to check with your financial planner to talk about, hey, based on your income and your situation, of all these changes, how many of them are going to apply to you? And then the last one that I'll mention, I could go through these all day. This bill was over 1,000 pages, so there's a lot to really digest here. And again, the final draft, if this gets approved in the Senate, who knows what they'll cut out, what they'll change, what they'll add. We'll just have to wait and see. But the last thing I thought I would mention is the state and local tax deduction. So right now it's $10,000 per year is what you can deduct. And they are going to increase that to $40,000 per year. Because what they were finding is a lot of the people in the areas of the country that have very high state and local taxes, property taxes, things like that, yeah, they were only able to deduct $10,000, but their total taxes were something like $30,000, $40,000, $50,000. So this state and local tax change will help those people. Again, no surprise, there are income limitations to this. A lot higher, though, because the income cap on this is $500,000. And this is going to run a lot longer. This is going to run for years 2025 to 2034. So I'm going to summarize really quick how this is going to impact a lot of listeners on this podcast. It extends the current Tax Cuts and Jobs Act that was put into place in 2017. So business as usual, so to speak. And in addition to that, the standard deduction is going up. No changes to how Social Security is taxed. That didn't make it in the bill. The other thing is state and local taxes. There's going to be an increase there from $10,000 to $40,000 up to $40,000. So that might impact you. HSAs and what you can contribute to them, how they can be used, that's likely to change. So that's something that's hopefully going to be a good thing for most people that do contribute and take advantage of HSAs. There's a lot of different parts to this. There's even a whole section of this bill that's funding for the border security and a lot of unrelated stuff to retirement planning that we won't discuss on today's podcast. All right, let's switch gears. Let's get into some listener questions. A lot of people say this is their favorite segment of every episode when we have time to get to them. So we're going to go through as many as we can, probably 3 or 4 today. How you submit your question, you go to our website, retirestrongfa.com. And for those people, we've mentioned this on podcasts before, our goal as a firm at Retire Strong is to help 100 families this year in 2025 get a retirement plan in place. So if you want to learn more about how you can be one of those 100 people, go to our website, retirestrongfa.com. There's a couple forms to fill out. We'll get in contact with you that way. So the first question, and I've gotten this question quite a bit, not only in meetings with clients, but also a couple people had emailed me saying, what's the best way to start withdrawing from retirement accounts, different investment accounts after you retire? How do you pick and choose which account to draw from first? And it's a fantastic question. And I'm going to do a YouTube video on this with sort of our planning. I'm going to go through a case study of a couple that has different types of accounts, Roth IRAs, 401ks, and brokerage accounts. And we'll go through a case study. It's going to be really neat. It's going to be very intuitive to show you, okay, if they did this withdrawal strategy, then, for example, their taxes would be X over the next 30 years of their lifetime. And the ending value of their retirement accounts would be Y. And then, okay, what if we did another strategy? Then we can map out, okay, this is the total taxes they would pay over the next 30 years. And then this is the predicted ending value of their accounts. And that's strategy number 2. And then we take it a step further and we say, okay, what about a hybrid between option 1 or option 2? We'll call that option 3. It's a different withdrawal strategy altogether. Maybe it involves some Roth conversions. And then by doing so, okay, this is the total taxes they would pay over their lifetime. And this is the estimated ending value of their portfolio at the end of their life. And the idea here is to say, okay, in an ideal world, we will pay the least amount of taxes with a certain withdrawal strategy, and we'll have the most amount of money left over for the next generation, or to pay for those long-term care costs at the end of our life, which there's no way to predict, unless you've got a crystal ball, what those costs are going to be and how long we're going to need that care. But essentially comparing those withdrawal strategies, and one might be, okay, we're going to spend all of the brokerage account first. And then we're going to go to the tax deferred, the 401k. And then once all that money is spent, then we're going to end by spending all of the Roth dollars. That is the conventional wisdom. That's what conventional wisdom back in the day, that was always the train of thought. We're going to spend all of our brokerage accounts. Then we're going to spend all of the pre-tax accounts down to nothing. And then we'll end with spending all of the Roth dollars. And spoiler alert, that we found after doing a lot of study on this, and of course, there have been some big changes to the tax code and how IRAs are passed down to the next generation, but it doesn't work out in your favor by implementing that conventional wisdom in a lot of instances. It really depends on your situation. Do you have pension income? What does your Social Security income look like? And when are you claiming it? And then what I would like everybody to do is to draw your 3 different buckets out. And we're going to do this on the YouTube video as an exercise together. But okay, we've got 3 buckets. The first bucket is the Roth bucket that grows tax-free. We have bucket number 2, which is your pre-tax dollars. So think traditional IRA or 401k. All your tax-deferred pre-tax dollars are in that bucket, which we know at some point you'll have required minimum distributions from. And then last bucket is your brokerage account bucket. This is your non-retirement account. You're going to pay taxes on dividends, on interest, on capital gains, likely from that bucket. And so if those are your 3 types of buckets that you can draw from in retirement, we would want to then say, okay, how much is in each bucket and how much of a piece of a pie does that bucket represent? So is it 25, 50, 25%? Meaning the Roth dollars represent 25% of your overall portfolio. The pre-tax represents 50% of your overall retirement savings. And then the brokerage represents the other 25%, the last 25% remainder of your entire retirement savings. So trying to say, okay, how much do I have in each of these 3 buckets? That's going to help you develop the starting point to a game plan of where those withdrawals should come from in retirement. And there's other people that when we put the pen to paper and we look at their situation, they're always really going to be in the 12 to 15% bracket. No matter what we do, they're always going to remain in that bracket. And there's really no getting out of it unless they did some big Roth conversions or something like that that would push them into the next bracket, which is the 22% bracket. So look out for that YouTube video that's going to be the retirement withdrawal strategy video. That's going to be coming out here in the next couple of weeks. The next question is about RMDs that we got this past week. We just had a client that was asking, okay, when I turn 73, what is that RMD amount going to be? And this particular person was told that it was 6% a year that they'd have to withdraw from their IRA. Now, it's not. It starts at 3.77%. There's a table that you can look up. We'll try to include a link in the show notes. We'll call that the RMD table. And it's based on life expectancy. But for example, at age 73, it starts off at 3.77%. So approximately, if you had $100,000 at the end of 2024, it's based on the value of 12/31 of the previous year. And at 73, we would need to take out approximately 3.77%. So if we had $100,000 at the end of last year, we would need to take out as an RMD $3,774. And a lot of people bring up, they're familiar with the 4% withdrawal rule. So if you're just taking your RMD at age 73, notice we're less than the 4% annual withdrawal. But as a reminder, for those people that are charitably inclined, you can use your IRA to do your giving once you turn 70 and a half. So of that $3,774 in our example, if your annual giving was $300 a month or $3,600 a year, you could use that RMD and send that directly to your church, let's say, and then you wouldn't pay taxes on those dollars. And for someone that doesn't itemize, that just takes the standard deduction, that might be very beneficial from a tax standpoint. So my takeaway here is, yes, we can plan ahead. We can estimate what those RMDs are predicted to be years down the road, depending on your age, when they'll kick in. And of course, the balance of you and your spouse's traditional IRAs. But also we can say, okay, if we're already donating to charities, why not use your pre-tax IRA as a way to take care of that? They call that a qualified charitable distribution, and you can do so once you turn 70 and a half. It's becoming extremely popular. And for a lot of people, it can help their tax situation, not only this year, but every year after that, when required minimum distributions are in play, and they are required. So I hope that helps. And like I said, a lot of people, when I ask them, do you have any idea how much your required minimum distributions will be? A lot of times they overestimate what they actually are. And they start off at 73 for those people. They start off around 3.77%. Now, the next question that I got was from a listener that was watching some financial guru out there that was recommending taking a home equity loan out on their house. And since the market is down, spending the dollars out of the home equity loan and then gradually pay yourself back. And this person was told that it's a better idea that if your investment portfolio is ever down, you're better tapping the equity in your home and living on the equity in your home instead of withdrawing out of your investments while the market is down in value. And this person went on to say that there might be tax, you could deduct the interest on the home equity loan by doing so. So there's some tax favors that you could experience as well. That this sounded like a rosy, good idea. But they heard the podcast and wanted to know my thoughts. And here they are, because I've heard this before. So first off, being able to deduct the interest you pay on a home equity loan, yes, you can do so, but it's got to be for a loan that you take out to improve your home. You've got to take the loan to do an improvement or a renovation to improve the structure of your home, not to live on the money, not to go buy a boat, not to give as a gift to somebody. So what you do with the money determines if it's tax deductible, the interest you pay on the loan. And this was a change with the 2017 Tax Cuts and Jobs Act. And I've heard people say, well, how would the IRS ever know? I just go by the book with everything. I try to live my life as honestly as possible and try to play by the rules. And then life is just a lot easier that way. If you just play by the rules, you don't have to bend them to make them in your favor. So from this podcast, I'll just tell you that if you're going to live on the money, you cannot deduct the interest on the home equity loan. Not only that, home equity loans right now, if you go to bankrate.com, that's a public website, don't have to put in any information. A home equity loan, you're looking at about 8.25% national average. So it's going to cost you 8.25%. We talked about there's no income tax deduction from the interest that you're paying. I just think there's got to be a better way. And I can tell you kind of what we do at Retire Strong at my firm is we come up with a bucket strategy knowing that, okay, there's going to be some tough times and we're going to have to adjust our withdrawal strategy to get through those tough times. And the thought process here is we need some money invested in a way that when tough times come, we can then tap into those accounts because they're not going to be down like maybe the rest of the market. Maybe they have a low correlation risk to the rest of the stock market. And certainly you want to have enough in those accounts that are going to kind of get you through that season, that stormy period where the economy, the stock market is not doing so hot. And then when everything recovers, which over time it historically does, then you've got to then pivot and adjust your strategy back to the way you were before the storm hit. But tapping into your equity in your home for living expenses in retirement, just because the market gets a little shaky, that just doesn't seem like a prudent strategy long term. I think you're going to get yourself into trouble, especially when your interest rate is 8.25% and could be higher. And that's the beauty with retirement planning is you get to decide the strategy that you want to put into place. I tell this to clients all the time. You are the financial deciders. And the last question this week is from a meeting that we had with a podcast listener. And they said, okay, as you look at our retirement plan specifically, what can go wrong with our retirement? What can pull the rug out from under us as we're trying to plan for the next 30 years? And so I wanted to talk about that because these are risks that people have as they're putting together some type of game plan for the next season of their life. So one of the things in our planning that could be inaccurate is, of course, how much somebody spends. Typically, people, when they retire, they say, okay, we want to live the same lifestyle that we've become accustomed to living for the last 5 or 10 years. They're able to then live comfortably. But then you've got to look at, okay, what are they going to spend more on in retirement? So in other words, if every day is a Saturday and you're like me and you do most of your spending throughout the week on Saturdays and Sundays, okay, now every day is a Saturday, how is their spending going to change? Maybe they're going to golf more. Maybe they're going to spend more on hobbies, spend more time spoiling the grandkids. Maybe they're going to spend more time on leisure activities and traveling. Who knows? Maybe they're going to eat out more with their friends. So when we're looking at our spending in retirement, we've got to say, okay, how's that going to differ than today? And the conservative way to plan is to say, okay, we're going to build in a fun or a leisure allowance, a traveling budget. Maybe we'll call that miscellaneous expenses. So you try to, in my opinion, it's best to plan more conservative and say, okay, what can go wrong here? Maybe our spending is more than we thought it would be. Okay, that would have an adverse effect. What if taxes are higher in the future than we had anticipated? That could have an adverse effect too. What if our healthcare costs in the future are higher than we had planned for? That would have an impact as well. What if we lived longer than we were anticipating? That would have an impact. What if one spouse passed away prematurely? Heaven forbid. That would certainly have an impact. What if our goals changed in retirement and we decided to buy an RV or to buy a condo, a lake house, something like that? That would certainly impact the plan as well. Certainly if you got a part-time job and there was more cash flow, there was income coming in, that would help the situation. But we're thinking of the things that, okay, what could throw us off track? What could jeopardize the success of our retirement? And really what it comes down to is a lot of instances we made inaccurate assumptions or maybe overly rosy assumptions, or our spending was dramatically different. And a lot of times with assumptions is people, they forget to think that, man, every year, everything you buy will cost more. And that's because of the cost of living. Inflation goes up year in and year out. A lot of people underestimate the cost of healthcare. And I even had a client that said he hired us after he had already retired, but one of the reasons why he hired us at that point was because his pension that he was collecting for a couple years had basically gone insolvent. And then the pension check that he was receiving went down dramatically, went down about 40%. So that's something that can dramatically impact your retirement. And certainly it's something out of your control. And then the last thing is, of course, our investments, our retirement savings. Maybe they underperform consistently, and we were expecting more return, more interest, more dividends, and to provide us a retirement income to help supplement our other sources like Social Security or pension income. And that's a big risk, is maybe our investment portfolio, our retirement savings just did not meet our expectations. And I think that's one of the biggest risks, because you, of course, can adjust how your investments are positioned over time. And it oftentimes blows my mind that some people don't put a lot of thought or planning into the investment part of this, how your 401k is invested and your other retirement savings accounts, because that's what's going to fund all of this for most people. And putting care and thought into, okay, how are we positioning those assets so they're growing over time and helping us fund this retirement lifestyle? Because what I hear a lot of people say is, oh, well, the last 10 years, my 401k has averaged X percent. And so if it keeps that up, I'm going to be just fine. And my question would be, we can't live by looking in the rearview mirror, because I don't think that's a prudent manner. The next 10 years are going to be wildly different than the last 10 years. And who's to say that you're going to experience the same growth that you have received the past 10 years? So maybe we need to look and say, okay, now we're in a different season of life and our goals are different now. And maybe some adjustments need to be made to those retirement accounts. And the reason I say that is things move so fast anymore with changes. I was watching a documentary that said it only took 20 years for vehicles to replace the horse and buggy. And prior to that point, people rode horseback for thousands of years. But all of a sudden, with the invention of the vehicle, it only took 20 years for them to dominate and just replace the horse and buggy altogether. And by 1940, that's all people drove was automobiles. And I think there was a famous quote by Henry Ford. I think it went something like, if I just gave people what they wanted, I would have come up with a faster horse. Hey, I hope this episode of the Retirement Made Easy podcast has been helpful. If you have questions, visit our website, retirestrongfa.com. I'll see you next time. And remember, always dream big.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The content in this material does not necessarily reflect the views of LPL Financial. This is a hypothetical example and is not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments might be appropriate for you, please consult your attorney, tax advisor, or financial planner prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. There is no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect completely against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxed as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59.5 are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Riders are additional guarantee options that are available to an annuity or life insurance contract holder. While some riders are part of an existing contract, many others may carry additional fees, charges, and restrictions, and the policyholder should review their contract before purchasing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the United States Social Security Administration or any government agency. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the U.S. Centers for Medicare and Medicaid Services or any government agency.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.